Rob's Child here with Chapter 21 of Security Analysis. Nothing I say is investment advice, and I have no intention to replace any content, but to supplement it and open it for discussion. Chapter 21 is regarding supervision of investment holdings. Regarding that topic, that title specifically, we start with the fact that before the 1920 to 1922 depression, not the 1929 depression, not the depression everyone talks about, but a depression that was actually 8 years before then, there was not really so much a need for supervision of investment holdings. After all, why would you invest in something that is considered to be a permanent investment if you have to keep reviewing, like, oh, is this a safe investment or not? And so that attitude became more, I guess people started worrying about it going into the big depression of 1929. And yeah, they turned out to be right. The people, talking about that. We had lots of problems with bankruptcy, obviously, in that period. And so that obviously gives rise to the discussion about treasury bonds being backed by the U.S. government. Even then, when it was, I believe it was backed by gold, the U.S. dollar. Maybe it wasn't even backed at that point. I don't know if that was later on, but regardless, it was a guaranteed return. You get your savings bond, you get your treasury securities, and this is pretty easy to digest. The obvious conclusion that why are you going to lend your money to a corporation for a bond that's paying 3% if you can get a treasury security with the same duration for 3%. Like, obviously, you're going to go with the treasury bond. It's infinitely safer place to have money, even though, well, very recently, the U.S. Just got downgraded from AAA to AA plus in their treasuries, which I think opened up an opportunity to buy them. But again, we don't do advice on this series. But yeah, so we have the superiority of the U.S. savings bond section about that. So, based on in 1940, the yields in savings bond, he writes about how they're really great, and that they were really the only sensible fixed value investment. It sounds like he was talking about a 2.9% return. I think maybe before then it was lower than that, and that was considered to be high. Too bad he didn't get to see what happened in the 70s, where we ended up with 30-year bonds, also, I believe, yielding around, over 15% T-bonds, treasury bonds. Like, I think they're high right now. We're just above 4% as of today, August 6th right now. But anyway, it has, exceptional safety of principal, and and that's the other thing. You can have exceptional levels of profits when bond rates are high, because when that goes down, the value of your bond automatically gets levered up by the duration of it. When your coupon, if you don't understand how that works, explore it, use Google. I don't want to get into that whole discussion here. But yeah, 2.9% then. I'm current. Anyway, let's move on. I said there's a hilarious quote here that starts with, "It was possible." And I'm going to quote, "It was possible, therefore, for the alert investor to sell out of such holdings to some heedless and unsuspecting victim who was attracted by the reputation of the issue and the slight discount at which it was obtainable in comparison with other issues of its class." I wanted to quote that because I thought it was really funny for some reason. I'm not getting it anymore, but hopefully you are entertained by it. So that's in reference to selling unsafe securities in the case where a loss is okay. So yeah, so it's well, the funny part is the heedless and unsuspecting victim that you're selling it to. So, if your bond appears to be unsafe and you've lost money on it, get rid of it. Don't hold on to it just because you paid more for it. If it turned out to be bad, you can get rid of it without worrying about it. This doesn't count as losing money. Losing money is holding on to it. When it's unwise, it's an unwise investment. So, and on the flip side of that, securities often get oversold compared to their earnings, even when they have a decline in earnings. So I guess sometimes people see a decline in earnings, and you can have bonds that sell off like way lower than they should when it's pretty obvious the company is going to continue and do fine. I think best examples related to that today are probably AT&T and Verizon right now. The common stock has something like an 8% dividend, and their growth prospects are limited, but like they're making so much money. Anyway, hopefully we'll figure out if those would be good investments according to Graham eventually in this book. It's just something I've been looking at, came into my mind. But anyway, moving on. Blue sky flotations are overhyped IPOs. Certainly saw a lot of that during COVID, right? And another quote from here he mentions is, "The sale of securities is not a profession but a business and is necessarily carried on as such." And he was referring to the role of brokers and how it's not to anyone's benefit to be advertising this security or that security. I mean, different now for ETFs, I guess, and mutual funds because they get fees on however many people are invested in those shares. But the last part of this, advice from various parties, exchanges, bank salesmen, and investment counsel was a new concept in 1940. So yeah. All right. So that was chapter 21. We finished with this. Just chapter 21 ends part 2. If there's anything that you got out of reading this chapter, anything you want to discuss about this chapter, please do so in the comments below. And if anyone does comment on any of these videos, I'm looking forward to joining in the conversation, and maybe we can learn some things together. With that all said, thank you for watching. Rob's Child.